Our top story right now, a global slowdown. The World Bank cutting its forecast for global economic growth for this year to 2.5%. That's down 0.2% from its estimate last June. Yahoo Finance's Brian Cheung joins us from the newsroom. And Brian, it looks as if we're all going to have a lot of thank yous owed to emerging markets.
That's right. The World Bank says that it only expects a modest rebound from last year. But even at that, they say they need a lot of factors to be in play to get even that. So their forecast for the full year 2020 is 2.5%. This is measured in GDP for the world. And as far as the large economies, not really a great picture. The United States expected to grow only 1.8%. The whole euro area, which has really been struggling to get inflation at 1.0%. And Japan having the same issue, only expected to grow 0.7% in 2020. Keep in mind, this is an already pessimistic view relative to the IMF's forecast, which we've got at the end of last year, which had forecast a pretty bearish already, only 3.4% global growth for the year 2020. For what it's worth, the World Bank says for its part that there are a number of factors that could actually present downside risk to that already gloomy forecast, one of them being trade tensions between the United States, China, and other parties, as we've heard maybe the U.S. even threaten Argentina and Brazil, in addition to the escalation of what they call geopolitical events. And one thing that's obviously in focus is the U.S. political tension with Iran, which could come into view as well. But in the long term, the World Bank says there are other issues as well. For example, slowing productivity growth, not just in the United States, but in other corners of the world, in addition to a problem of debt accumulation, which is countries maybe spending more than they can actually afford to do. So all of these things kind of factoring into what is a pretty gloomy outlook from the World Bank of only 2.5% GDP growth in 2020.
One of the things they pointed out with debt was the last 3 times in the last 50 years we've seen debt accumulation like this. They said it does not end well. But there was a new report from Deloitte which highlighted downturn concerns, finding that 97% of CFOs believe a downturn is already underway or at least will begin this year, right?
And this is a micro look at what's basically backed by the World Bank outlook, which is saying that you see CFOs at the company level saying we don't really see a great growth case in 2020. As well as you mentioned the statistic, 97% of the CFOs that were surveyed by Deloitte said that they do believe that a downturn is either already underway or will occur by the end of this year. What's important, though, is downturn is not the same thing as recession. So, yes, even though CFOs expect 2020 to be a worse year than 2019, we saw pretty solid GDP growth, albeit slower than in previous years. Some of them do expect it to slow down this year. Some of them do indeed expect a recession, but that's not necessarily the case for all 97% of those respondents. But again, signaling that at the company level, they also don't see the macro environment as generously as they maybe did in 2019.
Thanks so much, Brian. Appreciate it. We're going to dive into these numbers and forecasts a bit now and bring in Mohamed El-Erian, economic advisor. Bless you, Adam, for Allianz, who joins us from Irvine, California. We also want to introduce our panel for the next 90 minutes, Yahoo Finance's editor-in-chief, Andy Serwer, and Dan Roberts. Mohamed, let me start with you, because when I look at these different forecasts from the World Bank, what stands out to me really is that the growth is being driven by some of these emerging markets: Argentina, Brazil, India, Iran, interestingly, Mexico, Russia, Saudi Arabia, and Turkey. How does that seg with what investors should be doing this year?
So I think investors are generally decoupled from the more cautious tone that Brian talked about. And that more cautious tone is not just from the World Bank, from certain CEOs. It came also out of the gathering, the biggest annual gathering of economists over the weekend at the American Economic Association. But markets say that's great, but that's not what's driving asset prices higher. What's driving asset prices higher is extremely accommodating liquidity, particularly from central banks, but also from corporate balance sheet. And that is what is going to continue. So you need Mohamed, a major deterioration.
I'm just going to ask, can both be correct? In other words, usually when you see economists or CFOs, et cetera, have one view and the markets have another, one of them is perhaps right and one of them is wrong, or at least the timing is divergent. In this case, though, it sounds like that they both could be correct.
Oh, they have been both correct. They've been correct in 2019. And that's why you've got the very unusual outcome of a 30% increase in the S&P and a 12% increase in the bond index. You normally don't get those sorts of moves together to that extent. So yes, they've been both correct, and that speaks to why markets are short-term constructive. But if you look beyond the next few months, you've got to worry about not just economic uncertainties, but financial, geopolitical, political, social. So there's quite a list of uncertainties building up. But for now, all that matters is the positive momentum that's created by liquidity.
But they raise as one of their concerns, if you do look out as soon as maybe 6 months, the need for reform in the emergency markets. And they say in the report, improve tax policy, promote trade integration. Let's be honest. Do you think that's going to happen? Because if I'm an investor looking at these potential investments, I would not be so sure about that.
Yeah, I mean, they point to the need for more reform stories in emerging economies. We don't have any to speak of right now. They point to the need for policies to promote productivity in advanced economies. We're not getting much of that. And they also point to the increasing debt stock. So they point to all these things that require a policy response, a comprehensive policy response that gets beyond the central banks. And it's hard to see it absent a major economic downturn.
Mohamed, it's Dan Roberts here. Thanks for being back on with us. Let me just ask you your take. You know, with Mark Carney today talking about the need for some kind of stimulus. Now, of course, he's on his way out in March, so maybe it's the end of his time and he can take some risks. But with him talking about a stimulus, and also if you look at a week or two ago what China did with loosening the restrictions on Chinese banks to try to pump some money back into their economy, are we going to see more of these measures to try to loosen restrictions and stimulate those economies from global markets? And then obviously part two would be, how concerned should America be? Because Jay Powell talked about this in 2019, basically said, yes, there are a lot of slowdowns in economies outside of ours, but the U.S. chugging along just fine.
So then I tweeted on this morning. What Carney pointed out and what you said about China basically says there's scope for further monetary policy loosening around the world. Having said that, there's a really important qualifier. We are not going to get the scale and scope of loosening that we got in 2019. 2019 is going to go down as one of the biggest years of monetary policy stimulus. As to the U.S., have a look at Rich Clarida's speech this morning, the vice chair of the Fed. It's not often that you get in one speech, one concise, short speech, a really good summary of the what, the why, and the so what of monetary policy. And his bottom line is, despite what they think are easing headwinds from the rest of the world, despite that, we are going to stay low for long. And that's the message that the Fed wants the markets to hear.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.